Hi everybody. In the previous video, we talked about accounting for purchases of merchandise inventory under the perpetual inventory method. In this video, we'll practice recording sales of merchandise inventory using, again, the perpetual inventory method. This is a continuation of the demonstration we worked in the video lecture 4.1. We'll continue using the same worksheet that we started in that video. Under the perpetual inventory method, the sale of merchandise inventory requires two journal entries, one to record the sale and one to record the cost of sale. Let's work through an example. We sold 500 blue t-shirts at a selling price of $5,000. Those blue t-shirts cost us $3,000. Credit terms were $210 net 30 and shipping terms were FOB shipping point. Let's take a look at those journal entries, one at a time. The first journal entry should not surprise you at all. It is the same kind of journal entry that we made in chapters 2 and 3 when we were recording a revenue earned. This had to have been sold on account because we have credit terms. If we had received cash, we wouldn't have any credit terms. So debit accounts receivable and credit an income or revenue account called sales. So this is the exact same kind of journal entry that you've recorded in the past to record revenue. The second journal entry is necessary to record the cost of sale, and you were given that the cost of sale was $3,000. Let's look at that journal entry. The expense account on the income statement that is debited every time you sell merchandise inventory is cost of goods sold. So we need to debit cost of goods sold for $3,000, and we no longer own this inventory. So we have to credit our asset account called merchandise inventory for $3,000. So again, I cannot stress to you enough that when you sell merchandise inventory under the perpetual method, there are two journal entries required, the first to record the sale, the second to record the cost of sale. Okay, now let's talk about allowances given by the seller. They're referred to as a sales allowance. And in a sales allowance, the seller did not receive any merchandise inventory back from the buyer. The seller simply allowed the buyer a reduction on the cost of the inventory that the buyer purchased because something was wrong with it. And it requires only one journal entry because we didn't get any merchandise inventory back. So an example would be that we gave, in this sale here, we gave our customer an allowance of $3 each on 50 red shirts. The seller will use the account called Sales Returns and Allowances, which is a contra revenue account. See if you can record that journal entry. Start the video again to check your answer. The amount of the allowance is $150. That's 50 red shirts times $3 each is $150. The seller will debit the account called Sales Returns and Allowances, a contra revenue account, for $150, and will credit accounts receivable because the seller is telling the buyer that they don't have to pay this $150. So it's a reduction in accounts receivable from the seller's point of view. Now let's talk about a return of merchandise inventory from the seller's point of view. This is referred to as a sales return. Not only is the seller allowing the buyer to reduce the amount that they have to pay but the seller is also receiving that merchandise inventory, physically receiving it back into their offices or their warehouse. So this is going to be requiring 2 journal entries, one to reverse the sale. It'll be very similar to this one. And one to put the merchandise inventory back on the shelf. We received 20 shirts back from the customer. Let's do some math on that. I'll put it in red so it stands out. Let's find out the per shirt selling price. Well, the selling price of $5,000 divided by the 500 shirts sold equals a selling price of $10 each. Let's find out the per shirt cost of goods sold. The cost of the inventory that was sold was $3,000 divided by the 500 shirts sold equals a cost of $6 each. Now, the seller received 20 shirts back from the customer. 20 times 10 equals $200 sales return, and 20 times 6 equals $120 reduction in cost of goods sold, and an increase in the merchandise inventory again because it has to go back on the shelf. See if you can write those 2 journal entries. Pause the video, write the journal entries, then start the video again to check your work. The first journal entry is to debit sales returns and allowances for $200 and credit accounts receivable for $200. The second journal entry is to debit merchandise inventory for $120, the cost of the inventory that the seller received back, and credit cost of goods sold for $120 because we had recorded the entire $3,000 as cost of goods sold, but now we didn't sell 20 of those shirts, so we have to reduce the cost of goods sold for $120. Remember that this merchandise inventory was sold under credit terms of $210, net $30, and the seller received payment from the customer within the discount period. How does the seller take care of that? Let's do the math first. The first thing we have to do is figure out what the total receivable is before the discount. Well, the original selling price was $5,000, less the allowance on the 50 red shirts of $150, less the return of 20 shirts of $200, gives a total accounts receivable before the discount of $4,650. Because the customer paid within the credit period or the discount period, they will get a 2% discount to settle the entire amount that they owe the seller. So $4,650 times 2% is a $93 sales discount from the seller's point of view, and a $4,650 times 98% is $4,557 the cash the seller will receive. So again, this journal entry will take 3 lines, 3 accounts. Go ahead and write the journal entry. Start the video again to check your work. So debit cash, $4,557. Debit sales discounts, which is a contra revenue account, for $93. And credit accounts receivable for the entire amount of $4,650. Well, that's all for this video. See you next time.